Muchas gracias, Cristina. Good morning. Still, I'm shifting to English. So I am Marion Sanchez. I work with Ship2B, and I'm really glad to moderate this session today. Sorry, we have three great speakers today, and each very different, with a very different perspective on capital markets, on finance, and impact. So let me introduce first Natasha. Natasha Cazenave is the Executive Director of ESMA. So ESMA is the European Securities and Markets Authority. She will explain much better, but in a few words, she is the umbrella for national authorities. So in Spain, it's La Comisión Nacional del Mercado de Valores, for example. And at ESMA, they are in charge of overseeing capital markets authorities and ensuring financial stability in the EU system. Alfredo Ferre, at the very end, is the CEO of Recover. Recover is a textile company and is a spin-off from a traditional company, textile company, but they have been in recycling and sustainability since forever, since 1947. So it's a very large company now. They succeeded in growing organically, but now they have some private investors into their capital, and he will tell us about this experience. And finally, Oriol Vila, the Holaluz, is with us today. He accepted on last short notice to join us, so it's great. Thank you very much again. Holaluz, for those who don't know it, is the Barcelona-based 100% renewable energy supplier. They started in 2010, and 2 years ago, you launched the rooftop revolution with the aim to install solar panels in every rooftop. Where?
In Spain.
In Spain,
mainly
perfect.
In Spain.
Okay. And interestingly, Oriol is also the co-founder of the Foundation Capitalismo Consciente here in Barcelona. So this is for the presentation. So a quick word about financial markets. Financial market impact, I don't know, the marriage doesn't seem quite right, owing to the past financial crisis and the interest that seem to diverge, like in the past financial crisis, we observed that financial markets were not really at the service of the economy, or at least some bouts of them. And this led to a massive regulatory agenda reform that hopefully made them safer. And I would like to start with you, Natasha, to know, as a regulator, supervisor, if you think that now the capital markets and finance is in a better shape, better condition to finance the economy and the impact economy.
Thank you, Marion, and thank you for having me here today. So maybe just to start with your question, actually. So if we go back to the global financial crisis, it's true, it showed quite significant weaknesses and vulnerabilities, structural weaknesses in the system. And it did lead to quite significant changes in the way the financial sector is regulated and how it operates. And some huge chunks that were opaque until then are now under the light with more transparency requirements, and some key parts of the system that were not at all supervised now are under strict regulation. So is it perfect? Certainly you'll never hear me say that, but the system is much better and much more resilient. One thing I wanted to take the opportunity to ask is that at the time we realized that we needed to strengthen quite significantly the regulatory framework and the supervision. And actually ESMA, the European Securities and Markets Authority, was born after the crisis when the European legislators decided that they needed to have a quite stronger supervisory system for Europe. So they created what we call the European Financial System Supervision, which is composed of a number of authorities. So the European Banking Authority, the European Insurance and Occupational Pensions Authority, the European Securities and Markets Authority, and the European and the ESRB, Systemic Risk Board, to look at financial markets with a stronger oversight at the European level. And one particularity is also putting some specific entities up under EU supervision. So in a nutshell, who we are. So ESMA has 3 missions. Our role is to enhance investor protection, to ensure orderly functioning of financial markets, and financial stability. And we do that through a number of means, so ensuring we have a single rule book, so the same rules across the EU. We ensure also that we have a consistent way of implementing those rules, so supervisory convergence on the ground, making sure that the supervisors across the single market implement in the same way. Risk assessment, making sure we have the same understanding of risks. And then finally, supervision. And just to finish on that one, to come back to your question, Marion, ESMA has direct supervisory powers. So post-crisis, we saw that the credit rating agencies, for example, had some conflict of interest problems. And since then, they are under our direct supervision. So ESMA is the direct supervisors for credit rating agencies, for example, Moody's, S&P, etc. Now, if I come to your specific question, I think that what I wanted to say here, just to kick off the discussion, is that the financial system didn't show itself at its best during the financial crisis. And actually now, with the sustainability agenda, with the transformation, the transition that is required to move to a sustainable economy, it's actually an opportunity for the financial sector to live up to expectations and actually contribute in a positive way to what the market needs. And the needs are huge. So I just took one data source, but there are many, and they don't all give the same figures. But if you look at Climate Policy Initiative, they estimate that on a yearly basis, there are approximately $480 billion that are directed towards sustainable and impact investments. And the need would be 4.3 trillion on a yearly basis. So definitely the huge need for more financing of this area. So maybe I just stop there.
Well, thank you very much. And no, I understand that I think the authorities took it seriously, like the crisis, and there has been a revamping of the financial system, and more power to regulators and supervisors. So we'll see how it goes going forward. Turning to Alfredo, so as I said at the beginning, Recover is a spin-off from a very traditional family textile. You are the fourth generation of Ferre. And even if you were like doing recycling and operating in a sustainable way since 1947, you decided to go a step further in order to develop a disruptive and scalable model for the textile industry. So recently you opened your capital twice at large scale. You can maybe share us like the level. You are valued as a unicorn now. For now, you have only private sources of funding. And so, can you share with us your journey towards opening your capital and while remaining like in this sustainability path?
Thank you for your intro, and thank you very much to be invited. Well, definitely I can explain the journey. And basically, 75 years ago, the second generation of my family had no clue about sustainability, what this concept would mean. So they are not visionaries of what would happen in the future. The fact is that they recycled cotton waste because there was no cotton available in the market after the wars. So it was a kind of survival mode. The thing is that after many years, let's say improving this recycling process, using new technology, etc., we reached the apparel business, and but we became a kind of niche business inside the big, huge textile world. The fact is that if I ask the people what is recycled cotton, most of you will have no idea what I'm talking about. And this is the case today. I hope that you invite me in 5 years. The concept will be much more familiar for all of you. What happened is that in 2000, when I took the responsibility of the company, I decided to make a first change, is to declare that we were offering recycled products, because in the past, recycled means like second quality, rubbish, put it this way. So I was the one to declare this very clearly. So we became a kind of, let's say, special animal in the middle of the jungle. But this was key to start being a little bit more visible in the market, in the apparel market. The second I would say, milestone happened in, let's say, 2014, when we decided to grow and find more markets. And one of the groups that we visited to explain us how to grow the market in the United States, for instance, is you have to be more consistent in your marketing of sustainability and put a brand in your product. So we decided to name our product Recover. That sounds very global and very easy to understand what we are doing, recovering waste and transforming it into final products. Then what happened then? The textile industry is the second more pollutant in the world after the petrochemical. And the big monsters, I would say the big retailers, brands, started to be scared about their position in this world, saying, hey, we are damaging the environment of the planet. So they became very much more sensitive to that. So we came there and say, well, we have a solution for you. We recycle cotton. So if you replace the virgin cotton to recycle, you will save trillions of gallons or liters of water. You will save emissions. You will have a lot of positive impacts. They say, wow, we love that. The problem is that we are in Spain, just south in Alicante, and we are so small that we cannot even fill the, let's say, the shelves in one of our stores in Spain, put it this way. So you need to grow. So one of these monsters, and I can say who was that, is Primark, send me a challenge. Say, send me a proposal to scale your product and allow me to replace 30 or 35% of my cotton consumption. It is huge. It's more than 150,000 tons of cotton. So I started thinking, and I said, well, I cannot do it by spinning all this quantity of cotton, but I can do it with the fiber. That is just the start of the process, just the recycling. I can just put this fiber in hands of the conventional supply chain, and they will be the one to adopt this fiber and make you the front runner of sustainability. Okay, they accepted this project, but what was missing? Okay, we need to grow our capacity so much that we need a ton of money. And then that's when we found the only option that was just have a private equity fund that, by the way, normally you marry after several experiences. In that case was the first one. The first date was quite nice, energetic, and then we followed conversation. It was hard for me because I was the only one in the family to carry on with that. The family understood the process, said, okay, it's better to be a small part of a big project than a big percentage of the small project. And this is what happened. So finally, we found this American private equity fund that, after a certain serious diligence, came into the project. And at the end, they offered the possibility to Goldman Sachs to invest also in the company. They also took another small percentage of the shareholders, of the shares, and I would say with a big evaluation already, with evaluation of $1 billion. So that's why we're here. Basically, a good moment, a good project, and of course have our original conventional family mindset changed to be more open to bring foreign capital and be part of a bigger experience.
Great. No, it's a great story. Thank you for sharing. So it's true that making meet private interests, so in this case private equity fund and your company, can be tricky. Stock exchange can be easier because you go and you get listed. So it's more your story, Oriol. With Holaluz, you are transforming the energy sector as well. It's a disruptive business, and you decided to get listed in 2019. So my question would be, how is the marriage going on with the public investors? What are the pros and cons from your perspective?
We are a happy couple, I can say. No, first of all, I always like to make a disclaimer. Unfortunately, in Spain, there are no many companies or startups that go for IPO. So I got a lot of calls for sharing the experience. I'm not talking on behalf of public companies or companies that did an IPO. I'm just talking on behalf of Holaluz, meaning that I know what we did and I know the results, but I don't think we are benchmarking on that. So please take this into account. So when we began at Holaluz back in 2010, we really wanted to help the world to be powered 100% with green energy. And we did so only by supplying 100% green energy to our customers, by putting the customer in the center, and by using technology to give savings to our customers. And also in a company where we wanted people to develop themselves 360. And what I'm telling you this, because when this is part of your core business, of your value proposition, then I think it's when this really worked. So when we decided to go for IPO, our first slide was talking about this, was talking about our culture, was talking about our values, and that was the first thing we were talking to investors. And we actually, it's quite funny because we got the advice from our private banking advisors that were coming with us. They said, why wouldn't change this? And we said, no, we are not going to change this. This is who we are. So the investors we wanted to find needed to be somebody who really loved what we were. So we didn't change it. And we succeed. So actually, investors really like it. And I would say that as this is part of our core business, this is the reason why it works. So even though on tough times, and believe me that in the last 2 years in the energy sector, a lot of things happen, but even in the tough times, when this is part of your core business, when this is part of your core value proposition, there's no discussion about, there's no trade-off about should we change or not. So I would say this is why the reason this is still a happy marriage, even though in the public industry. When I think comparing this being public to private funds, I think there are many other differences, but mainly I would say I like to point out mainly two. First is that when somebody or a private fund gives you the funds, are the funds that they are managing, and normally they are in the board representing these funds. So at some point, it's much easier to have a conflict of interest between what the company needs and the returns this private fund needs to give to the LPs. While when you're on public, of course, there are also some independent advisors that represent the investors, the public investors, but there's no such conflict on this. I mean, I'm not saying they are easier advisors because they represent the independence, so they are there to be sure that we are working very hard and we are working toward our goals and so on. But it's a change when the money they invest in the company is not their money compared with the private ones. That's, for me, it's one of the reasons. And second, I would say is expected return. I mean, we have a lot of little investors that I'm not going to say they would not love to multiply by 10 their investment. But if we grow 50%, if we multiply by 2, they're happy. While on the private sector, and especially on the venture capital and so on, they expect a 10x return. And when you expect this kind of return, pressure and, again, a conflict of interest between what you are doing and the economic results are much more higher. So at the end, in our experience at Holaluz, we are a happy couple. Hopefully we will continue like this.
That's a very interesting point. There are different perspectives between private and public sources. And Natasha, turning to you, at ESMA you have this vantage point about investors in the market. So it's and you have an agenda to make sustainability impact get into more into the subconscious of investors. And so can you tell us a bit more about this agenda, whether it is sustainable finance or other products?
I'll try to take the big picture of sustainable finance briefly to sort of really just set out where we are in the EU, and then try to zoom into some of the points that I think are of interest for this audience. So generally, the EU is, as you know, a pioneer in this area and has tried to move the agenda internationally in this space. So since the action plan they put out in 2018, there's been quite a few big milestones that have been achieved in the European fora. So the first is the taxonomy. So we now have a common language on what we mean in terms of activities that could be qualified as sustainable. It's still work in progress, there's still a lot to be done, but at least we can come together on what exactly that means on that journey. The second big pillar was the Sustainable Finance Disclosure Regulation, which is a piece that is designed to ask financial entities and financial products to provide information so that investors can then make informed decisions. They know what they buy, why, and what they're trying to achieve. So that's a very important piece that came out. Recently, there was an agreement for the Corporate Reporting Directive, Corporate Sustainability Reporting Directive that will come, and that will provide a missing piece, which is exactly the footprint of a given issuer, so a corporate. What exactly do they do? Could they provide the data, so their own sustainability journey, and put that in sustainability standards that are agreed? And there, I'll come back to that because I think it's important that you see also what's going on the international scene on this. So that's a bit the scene, very much work in progress. There's still a lot to be done on the journey to complement, but the objective is to have a comprehensive framework to support this transition in a sort of a consistent way. ESMA's role is to provide technical input to the European Commission, so we've provided a lot of guidance and Q&As to try and help. We're conscious that it's going very fast, and so there's a lot of questions coming in, and we're trying to help. We're also trying to help to have a consistent and convergent approach across the single market, because as I was saying, it's going very fast, so different countries are going at different pace. What I wanted also to zoom into, if you look at ESMA's particular priorities in this area, we put out a particular roadmap. So beyond these key pieces of legislation that we're trying to support, there are 3 areas that we think we need to be focusing on at the European level. The first is understanding the risks. So making sure we have a good understanding of what exactly the sustainability journey means in terms of impact on the markets, real economy and financial markets, and making sure we have the proper resilience there, developing stress test scenarios and things like that. The second big piece is being humble in this area and developing capacity. So we are financial regulators, so our training will be more in the financial system, in economics, in legal backgrounds, and we need to grow and learn what this means. What is impact, what is sustainability, so that we can be effective also in our role. So we have a very big plan in terms of capacity building. And the third one is the one I wanted to zoom in here, is greenwashing. There's a lot of talk about greenwashing, but we don't always agree what exactly that means. So on this journey, to make sure that Alfredo and Oriol, they get the right investors out there, we need to make sure that there's a good alignment between what the investor thinks he's going to get, what his intent is when he invests or she invests, and what exactly the offer is. And there's a lot of concern out there that there might be a disconnect. So this is not at all to criticize my panelists here, but more in the general system because of the speed at which the demand is climbing, the speed at which people trying to propose offers. There is a risk that the claim is not always substantiated, and that's what we call greenwashing. So we're trying to fight for that, and we've put out 2 consultations. One is a call for evidence, very easy to respond, so anybody in the room input, very welcome. 10th of January is the deadline. And here we're just trying to say, what are the areas in the market that are the most prone to risks? Is it lack of data, lack of definitions? Is it issuers' claims? Is it just understanding? Is it fund products? That's what we're asking. And the second piece we're putting out in the area of securities regulation is the names. You go out to investors and you propose a product, and we would like to seek your input to think whether we should have a stricter regulation around the name of the product, because that's what the investor looks at first. This is the name, this is what I'm going to buy, and sometimes there could be a mismatch between what the name conveys in terms of the intent and what it can actually deliver. If it's only secondary markets issuers, maybe not great. So that's where we are in terms of our initiatives. The last point I wanted to make in terms of corporate reporting is there's international work going on, because these are global markets, to have international standards for sustainability on the same footing as international accounting standards. And what we are advocating in the European Union, there are also European standards that are being developed, and ESMA will have to provide an opinion to the European Commission whether we agree with those or not. And one of the key elements that we will support in developing that opinion is making sure they are interoperable with that international standard, to make sure we have the same language. So if a firm wants to scale or wants to reach out to international investors, that they speak the same language, they can provide measurements, key information that is compatible at the European and international level. So that's a little bit, it's a bit broad, but this is a bit where the scene where we are today.
Great, that's a big program, and that's lots is going on at the financial sector level. And I think this echoes some of the previous panel call for measurement, standardization, etc. And we heard also from, I think, the previous panel about a new global financial order. And here, and we heard also a lot about emerging markets. So I would like to come back to you, Alfredo, about this, because we cannot talk about social equity if we are not talking about emerging markets. With Recover, you are opening subsidiaries in emerging markets. Some of them already exist. What is the role of capital in ensuring that this transition in these markets can happen?
It's key. Basically, I won't say that we are having different hubs in different emerging markets. They will be the big hubs for us, because it's where the textile production is located, essentially Bangladesh. So you can imagine Bangladesh, the potential as a country, but what we are creating around our factory is a kind of ecosystem, and the ecosystem is very, very small companies today. They need to comply with certain regulations, health, safety, etc., that are let's say, needed, they are required from the final customers. I would say the brands and the retailers. So everybody has to comply with that. So okay, we are covered because we have enough financiation from our core stakeholders, 33. But they are starting to demand some local investment, financial needed, and this local financiation is arriving, and it's arriving because every time that we speak about sustainable apparel as a promoter of sustainability, the governments are happy to be hosting this companies, recycling companies there, and also happy because we are promoting a change in the work conditions, in the level of safety in this kind of small companies. And the local banks are starting to bring money. Of course, they require certain support from international banks that will be the ones to really bring this kind of business. But essentially, the role of local financiation is very, very important.
Okay, no, great. And I would like to ask each of you a last question about the perspective that you see in the investors' attitude, behaviors. Public investors, like in public markets, but also private, and if there is a trend towards and especially in the capital markets, in terms of return, in terms of horizon of investment, in terms of impact requirements. So, is there? Do you observe something from the investors that is changing in a bad or good way? Oriol?
First of all, something I forget to explain in my previous presentation. There are some downsides being public. I would say that the main one is the exposure you have, both with the information, and you have a price stock, and sometimes when in your strategy you are looking for raising more capital or for doing some M&A, for the bad or for the good, you already have a public signal, so this gives you some pressure, and sometimes it may even you don't want to take some decisions on the short term, so you can feel this pressure being on the public. So on your other questions, do we see these trends and what to do for the investors? I think that if we talk about in impact terms, there's no doubt. I mean, everybody wants to invest in impact. There's no trade-off. If I have a company that can have a positive impact versus another that doesn't, I mean, there's no trade-off. The trade-off might be in the return I expect from this investment, or in the time I give the company to give me back this return. And for me, the key is the time rather than the multiple I can get. You talk about that I'm part of conscious capitalism. Conscious capitalism is this movement that was created in the States 10 years ago by Raxi Sodia and John Mackey. And basically what they state is that they found out that companies that follow 4 pillars can have can generate much more value, but in the long term. They said that if you have a higher purpose, so making money is a consequence of doing good things, not a purpose itself. If you have a strong culture, how things are done within your company, if you generate value for all the stakeholders, not only for the shareholders, but for all of them, beginning with employees, but also with providers, with shareholders, with the stakeholders, sorry. Also the planet, it's another stakeholder. If you generate value for all of them, and you do it in a conscious way of leading the company, the value you will generate in the long run will be much more higher of not doing so. So at the end, my point is, valuation is not a problem for me. The point is how many time you give the companies to deliver this value.
What about you, Alfredo? Do you have a...
Yeah, very, very briefly. Not being a super expert on this, because I don't have too much experience. What I believe is that a sustainable company, a real sustainable company, has a path with a rhythm. And most of these investors have a different path. It is basically exit and how much X they put on the original investment. So what we are, let's say, struggling is in this strategy rhythm that is different. And we sometimes have to bring some context of, okay, this is a long-term journey and we cannot go at that speed. And we would damage these sustainable facts by speeding up the certain parts of the company's activity. And secondly, talent. A lot of these investors are very conscious on what people is working in the project, and they normally are selecting or somehow controlling that talent. And for sustainable companies, we need very specific talent where the sustainability is part of the DNA. It's not that they learn, it's that they have it in their own decision-making process. So I believe these 2 aspects are the ones that really keep us a little bit more, I would say, anxious.
Okay. And Natasha, one final thought about it?
Briefly on this, so again, maybe more the macro view on this. So we've heard the change is actually happening in the real economy. So the financial sector's role is to support and to fund, but the changes, they really happen in the real economy and in companies. And so we need to reconcile the incentives on both sides. That's the most important. What we see on a macro level is the very clear, strong demand for sustainable investments and products. I think we haven't spoken specifically of impact, but clearly there's something that's important when we look at the surveys and you speak to investors. It's been done in a number of countries in the EU. If you ask an investor, what do you want to invest in? Do you want to invest in sustainability? The way they understand that is, I'm going to invest to have an impact. And so we have to be very careful in the type of products we propose, because some of the products out there, they're called green or sustainable or ESG. They do not have a direct impact, so there is that risk of disconnect with the individual. If you look at the figures, I talked about the SFDR, the disclosure regulation. It created category of products. So Article 6, I do nothing on ESG. Article 8, I do a little bit. It's part of my investment proposal. Article 9, it's my main objective, just to make it simple. And what we see in terms of figures is that in the past 12 months, you have 4,500 UCITS funds, so that are investment vehicles for individuals, that have been launched or reclassified as Article 8. And that represents, and 500 have been reclassified as Article 9 or launched as Article 9. So that's 5,000 funds. And they represent collectively 5 trillion euros assets under management. So the amount of investment vehicles that have some degree of sustainability in them, or at least present themselves like that, is significant. So we need to make sure that that actually matches what I was saying in terms of the perception at the individual level. So what this tells us, for me, there's a huge responsibility collectively from the public sector and the private sector to support that demand in a responsible way. And I just want to pinpoint 4 points. The financial advisor at the point of sale to make sure that there's a good understanding between what the offer is and what the investor's preferences are actually expressing. Financial education, so to make sure, and also sustainability education, making sure that the investors actually understand what's the underlying. It might be in the long-term labels that might facilitate, actually, at the end of the day, the ability of a European citizen to know what he or she is buying. And really thinking hard about incentives. You know, the previous panel talked about Apocalypse or Titanic boat on which we would all be facing the wall. So how do we make sure we create those right incentives so we tackle those most difficult issues and reach the good outcome? Sorry, I was too long. We have a timer that is flashing here. Shoop. Done.
Perfect. Thank you very much to all of you. And it was a great discussion.
Thank you, Marion.